Welcome back to part 2 of our video lecture for the Affordable Care Act. And in this part 2, we're going to be calculating very basic examples of the shared responsibility payment and the premium tax credit. Let's take a look at a Form 1040 that we're familiar with. And here at the top, we would identify the taxpayer and the spouse if it's a joint return, and a listing of the dependents being claimed. And all of these individuals have to be covered with health insurance for the year, the so-called minimum essential coverage. And we would indicate so here on page 2 of the 1040, line 61, by checking off this box here for full year coverage. So if that's the case, we just leave this box 61 blank. In other words, there is no shared responsibility payment. Now, if any one of those individuals listed at the beginning of the return are not covered with health insurance for any 1 month during the year, then there may be a shared responsibility payment. But there's exceptions to that, exceptions to paying the penalty. And those exceptions are claimed on Form 8965. So let's say that the taxpayer went to the government marketplace trying to purchase health insurance but didn't qualify. Then possibly they would be given an exemption. And I think it's a certificate. I've never seen one. Typically, if you would go to the marketplace, you would want to qualify to purchase health insurance. But here, it's exempt, the taxpayer is exempt, and you would indicate so on this form here. The more common exemption would be claimed further down on this form because the taxpayer's income, be it the household income that includes dependents' income filed on the dependent's return, or here the taxpayer's gross income, are below the filing threshold. So if you remember in chapter 2 of our textbook, we identified taxpayers that are required to file. But here, if the taxpayer is not required to file because their income is below a certain threshold amount, typically that's the taxpayer's standard deduction plus personal exemptions. If the gross income is less than that, all we would do is just check off the box here, and that's it. Our taxpayer is exempt from the shared responsibility payment for any of those individuals being reported on the tax return. Now, if we cannot check off this box, there are other exemptions. Here you would identify the specific person that meets those exemptions, and either for the whole year or the specific months they would qualify for the exemption. And here the type of exemption indicated by a code, letter, or number that are listed in the instructions to this form 8965. So looking at those instructions, again for exemptions for the shared responsibility payment, I believe it's on page 3. We've already talked about the low income exemption. Here's another one for low income. You have to calculate the amount here using a formula. Possibly a common one is if the taxpayer is between jobs and not covered by employer health plans. If that non-covered period is less than 3 months, here is exception B that you would write back up here in this column C for the specific individuals that are claiming that exception to the shared responsibility payment. So let's say that our taxpayer doesn't qualify for any exemption. Now you gotta calculate out the penalty. And you would think the penalty would be calculated on this form, this 8965. But there is no form to do the calculation. The calculations are done in the instructions to this form 8969. Here, figuring out your shared responsibility payment. So if you scroll down the instructions, beginning with a flow chart, looks like on page 14, you would identify three different dollar amounts that are summarized at the end of this flow chart. Here's $1 amount, so-called a flat dollar amount. And if I scroll back up here, you can see those flat dollar amounts. For each taxpayer, each person over age 18 or older, the flat dollar amount is $325. If the person is under 18, the flat dollar amount is $162.50, or half of that, $325. So you would multiply these out and add them up to get a total. But there is a maximum amount per tax return, and then that's this $975. Again, you would enter that down here as one of the three amounts we need to identify. The second amount is a percent of the taxpayer's income. So you would get probably the AGI of the taxpayer, possibly income also from dependents, and subtract out a dollar amount. Probably it's the standard deduction, and multiply it by the excess by 2%. These flat dollar amounts and percent amounts are probably changing every year for inflation. And here's the second amount here. There's a further worksheet further above to calculate this amount in line 2. Then we look at line 1 and 2 and take the larger of those two amounts. Then in line 3, would compare that to the cost of a so-called bronze health plan. That would be these amounts here based upon the family size being claimed. So you compare that now with the previous amount, and you take the smaller. And here is the shared responsibility payment for the whole year. Now, if you're only going to be penalized for certain months of non-coverage, then you have to go further down in the instructions to try to calculate out a monthly penalty. Yeah, a monthly penalty. So let's take a look at an example here for a shared responsibility payment. We have Jim, single, no dependents. He doesn't have any insurance coverage for any months. He's going to be penalized for the whole year. Of course, he has no exemption, otherwise he wouldn't be penalized. And his income is $40,000 for the year. His standard deduction, a so-called threshold amount, is $10,300. So the flat dollar amount we saw in the instructions would be $325 for the whole year. The percent amount, we would take his income for the year and subtract out the standard deduction to get the amount that's taxable. We multiply it by 2% to get this $594. Then we compare these two amounts and take the larger 594. Then we find that average bond premium for one person, here's that amount we saw on the instructions, and compare it to this larger amount. And of these two, we take the smaller, or that $594 for the whole year. And if he's exempt for certain months, we would take a monthly rate, divide this by 12, and here's the amount of the shared responsibility payment for any month that he did not have insurance coverage. To promote taxpayers to get insurance, the government provides a tax credit. Let's go back to the 1040 form. So we just talked about entering the shared responsibility payment here in line 61. To promote people buying insurance through the government marketplace, down here in line 69 is a premium tax credit. Now, this credit can be used during the year to help pay for any health insurance purchased through the marketplace. And if there's any extra credit left over because you didn't use up all that credit for the year, then the balance would be reported here in line 69 as a refundable credit. If you remember here in chapter 9 of our textbook, the credits down here are the refundable type, better than the non-refundable type reported up here. Now let's say that when you first had our taxpayer apply for health insurance with the marketplace during the year and you calculated the credit, but after the year is over, the taxpayer had used more credit than they had qualified for. Now what they have to do is pay back that extra so-called excess credit up here in line 46. And you would combine that with the regular income tax in line 44. So if you purchase health insurance from the marketplace, you're going to get a Form 1095A after years over, and you got to prepare this Form 8962, either showing you have extra leftover credit that you're going to get back, or here you have to pay back credit. This is to so-called reconcile the estimate during the year compared with the actual after the year is over. Let's take a look at a Form 1095A. So after the year is over, if you purchase health insurance from the marketplace, the taxpayer is going to get this form to report the results for the year. Now there's other versions of this 1095. There's a B version that comes from the insurance company. Remember, A is coming from the marketplace, the government marketplace. B would be the health insurance company. Could be Medicare, could be like here in Hawaii, HMSA or Kaiser. There's also a 1095C that comes from the employer health plan. But again, what we're talking about here in this video is calculating the premium tax credit that's only available when insurance is purchased from the marketplace. And then only the 1095A is going to be used to calculate out that premium tax credit. So here's our taxpayer identifying individuals covered by the health insurance purchased through the marketplace, and then the dollar amounts that were incurred during the year. So that our taxpayer Gordon had purchased an insurance policy that has a total cost of $416.67 per month. And here is how much of the credit he's used in advance to help him pay for the health insurance. So the difference between the two looks like it's $300 a month. It's coming out of his pocket during the year to help pay for the insurance. And it's nice if every month is the same. So at the very end, all we have to do is work with the totals for the whole year. In other words, Gordon's health insurance through the marketplace has a total cost of $5,000, of which he used $2,000 of his premium tax credit to pay for the insurance during the year. In other words, he paid out of pocket $3,000 during the year. Now to calculate the amount of credit he qualifies for the year, we need this artificial middle column called the second lowest cost silver plan premium. Okay, so this amount here is really helping us calculate out the credit for the year. And here's how much he's using per month. So after the year's over, we would use this information really here at the bottom, if it's all the same for the every month during the year, and report it on form, I'll get it here, Form 8962, identifying our taxpayer, his family size. Here's his income for the year. Now it could vary from the amount he had estimated when he had claimed or filed for insurance with the marketplace. Okay, so if his income is higher than what he had used to get that credit with the marketplace, he's probably going to have to pay back some insurance credit. Or if his income is lower, this is actual now, than what was used to estimate how much credit he applied for, possibly he'll get more credit or a refund. If he's claiming dependents, possibly the dependents' income have to be included in here. And we will get a total and divide that total income for the year by the poverty level. This is 100% poverty level for the 48 contiguous states. But because the cost of living is higher in Hawaii and more so in Alaska, there's different poverty levels. You have to look in the instructions. It's table 1, I believe, for this 48 states in the instructions to this form 8962 to get this amount here. Again, this is 100%. So if you divide it into our taxpayers' total income, you get the taxpayers' percentage. If the percentage goes up to 400 or higher, that means the taxpayer does not qualify for any premium tax credit. So ours is lower than 400, so we continue. Now this percentage is looked up again, this time in another table, a table 2, I believe, in the instructions to this form 8962, where we would get a factor. This is telling you it's expected that our taxpayers spend at least 8% of their income to help fund their health insurance. So 8% of the income comes out to this 2,369. This is the amount of they have to pay. Now you compare this with the price of that silver plan. Well, we'll see it down here. Here's the actual cost for the whole year. Remember we saw that from the 1095A form. And here's that silver plan cost. Our taxpayer, Gordon, is expected to pay that 8% of his income. So in other words, the difference here between the silver plan and is how much he's expected to pay is the amount the government is going to help subsidize the cost with a tax credit. We were also told that on that 1095A, he had only used 2,000 of the credit to help him pay for his actual insurance during the year. So the difference between this 2831 and the actual amount used of 2,000 eventually is going to be calculated to be a refund down here that he gets to claim on his 1040 form. Looks like line 69. Now let's say that the amount that he had used during the year is less than the credit that he would qualify for. Then the difference here would have to be paid back as an excess credit that was used during the year, and that's calculated further down over here. There is a dollar amount depending upon his income that he could pay back. Yeah, this amount here that you would look up in the instructions. So again, going back to the 1040 form, if he has some unused excess credit, it would show up here in line 69, which is nice, right? You want to get back some money. Or if he has too much credit during the year, then he has to pay it back up here in line 46. Now keep in mind this is an illustration, very basic illustration, and the dollar amounts and probably the reporting requirements are changing over the years. They're kind of phasing in the Affordable Care Act. Okay, so if you have any questions, email me, kamida@hawaii.edu.